Okay, everybody, I think we have everything ready for us. Okay, and we have a lot of people on the line with us. Thank you again for joining me. Again, my name is Dave Aquino. I am with Microquant, and that's also valuecharts.com. I am the live trading room moderator in the area of stocks and options. So I'm looking forward to bringing you this strategy that we use consistently every week in the trading room to generate consistent weekly income. And I think you'll be excited about the opportunities of this particular trading strategy. So again, thank you very much for your attendance. Okay, so if those of you not familiar with GoToWebinar, if you have any questions during my presentation, feel free to go ahead and submit it via the GoToWebinar side menu. I will try to answer them as we go, but I will try to make it consistent so I don't interrupt the flow of the presentation for everybody. Yes, the webinar will be recorded, and so it will be available after the fact. Thank you. Okay, let's go ahead and go. All right. Here's a little bit about me. Again, my name is Dave Aquino. I graduated from Vanderbilt University in 1995. Soon after that, I became a Series 7 broker, a full broker with Merrill Lynch at age 23. Honestly, it was amazing what I didn't know at the time at age 23. My assistant was 10 years older than me, and my mentor was a good 20 years older than me. But I learned a lot in that time period about the markets, about people, so good times there. After I left Merrill Lynch, I joined the Vanguard Group and migrated to their asset management service as a senior advisor. While I was there, I managed the appreciated stock portfolios and developed cash flow strategies for those highly appreciated stock. So I have a lot of experience with options and generating consistent cash flow. I've been trading in the stocks and options live trading room. Actually, I haven't updated that. That's going on 19 months now. So I've been trading with the trading room 19 months, and it's been a lot of fun and a lot of profitable times. All right, quick risk disclaimer. We here at Microquant want you to know that trading or investing carries a high level of risk, and it is not suitable. Thank you very much. Sorry, guys. Again, this is the only slide so far that I jumped to. Yeah, the market took a lot out of me today. It was very exciting, a lot of movement, a lot of good trading. It just takes energy to trade. So thank you for yelling at me. I appreciate that. Again, that's me. Okay. Again, we want you to know that trading or investing carries a high level of risk and is not suitable for everybody. Before deciding the trade, you should carefully consider your objectives, experience, and ability to tolerate risk. Now, this content is subject to any change without notice and is provided for the sole purpose of education and helping you make your own independent investment decisions. Now, valuecharts.com has taken considerable measures to ensure the accuracy of the information contained herein. However, ValueCharts does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inavailability to access the information or delay or failure in the transmission or the receipt of any instructions or notification in connection herewith. Now, any past performance results are shown for illustration and example only. They are hypothetical and as such have many inherent limitations. Now, no representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Most importantly, past performance is not necessarily indicative of future results. Here's CFTC Rule 4.41. It's a U.S. government required disclaimer saying that trading futures and options has large potential rewards but also carries large potential risk. You must be aware of the risk and be willing to accept them in order to invest in the futures and options market. Do not trade with money you cannot afford to lose. This is neither a solicitation nor an offer to buy, sell. Futures, stocks, or options on the same. Now, no representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this website. The past performance of any trading system is not necessarily indicative of future results. If you have any questions, feel free to contact us at support@microquant.com. Thank you. All right, let's go ahead and get to the reason why we are here. We are going to talk about the 11-hour option spread strategy. It's a very interesting name. You'll see why I've named it that. And but first, because we have varying levels of investors and traders in the room, want to talk about some basic option information, talking about the what we call the Greek of time, theta, for those of you who know it. It's called, it's reflective of the time decay of the options that we trade and how that comes into play that brings us profits. And also specifically when we're trading weekly options, how does that weekly calendar also come into play? And once I touch base on those two items, we'll go ahead right into the 11-hour option spread strategy, and I can give you some information on that. Thank you. All right, no questions? All right, so for those of you that don't fully have a good handle on options, options are basically a vehicle that is created and the price is determined by the value of some underlying stock. That's why it's called a derivative. Its value is derived from the underlying stock, certain aspects of it. This is the Black-Scholes option pricing model, and it was actually formulated by Fisher Black, Myron Scholes, Robert Merton in 1973, and they later on won the 1997 Nobel Prize in Economics. Basically, the formula is used for calculating the fair value of an option. And again, the definition is it's a derivative whose value is based on some sort of underlying that can be described by certain Greek letters, or that's the part in this equation. And you know, looking at the equation can be intimidating, but don't worry about that. You just need to know what Greek is affecting the option because of particular price action or time decay or volatility or things like that. But the one that we are most interested in today is actually theta. Theta is the Greek part of that that option equation that describes the option's sensitivity to time. Okay, sensitivity to time, to expiration. Remember, an option has value, and it is, hold on, let me get my pen. What happens is, if the price stays, if everything else stays the same, an out-of-the-money option will slowly decrease in value until we hit expiration. Okay? It is a geometrically accelerating decline. Okay? The slope gets steeper as you get closer to expiration. That's the most important aspect of options. Again, theta is the option sensitivity to time. It is a direct measure of time decay, and this amount increases rapidly as the option approaches expiration. For monthly options, the greatest rate of the loss of time is the last month. So if you have 3 months out options, well, the third month, the second month, those are okay, but the last month, the month in which it actually expires, that's where the greatest rate of loss of the value of the option occurs. Now, if we're talking weekly options that usually have a lifespan of anywhere from 7 to 10 days, the greatest rate of loss of time decay is in the last 1 or 2 days. Now, as traders, as we carry out this option strategy, we become option sellers. We want, because what option sellers use theta to our advantage. We want to collect profits due to time decay. Okay, we want to do this every single day. The same is true when we are writing credit spreads. So you can directly sell options, or you can sell credit spreads, which is basically the same thing. You're taking a short position. You're selling somebody something that has value. But what happens is that item that they have, it decreases in value. The best way I like to describe it is this. Let's say Willy Wonka is offering tours for his factory, but you have to get a golden ticket. Now the difference is this compared to the movie. He might put out 10 golden tickets out there, but he only has 5 days he's going to open the factory. So those 10 people stand there on the first day. Okay, he draws the ticket, and let's say I sell my ticket to somebody that really wants it. Okay, so he sells it to me for I sell it to him for $10,000. He doesn't get in the first day, second day, third day, fourth day. He's only got 1 day left. That ticket that I sold to him for $10,000 is worth less than $10,000. If he comes to me and says, Dave, I'm afraid that I'm not going to get in, will you buy my ticket? It still has a chance to go in. I said, that's fine, but I'm only going to give you $2,000 for it. He's like, well, I paid you 10. I said, but time has gone by so that the option, the chance of it becoming fruitful is less. So that's why the value of that ticket is not $10,000, it's $2,000 now. Okay, so it's decaying. That's kind of how I like to visualize it. So same thing, if I sell a credit spread and it's 5 days out, it's worth more than a day out, and then now I only have 1 day, and then it might expire worthless. That's why it's geometrically declining. Okay? All right, so this is a good graph of it, of a monthly option expiration. You can see this is 60 days. So right here at 90 days, the value of the option is worth $5.30. Here at, at 90 days. Okay. Here at 60 days, it's only worth $4, maybe $4 even. Okay, it was worth 5.3. Now it's worth 4. Here at 30 days, it's only worth about 3. Now, 1 week out right here, maybe 5 days left to expiration, it's worth 1 1/4. Okay, just like I said, the golden ticket. Here you have 90 days, 60 days, 30 days, 7 days. It becomes worth less and less for out-of-the-money options. Yes, this video is being recorded, John. All right, any questions on that idea of time decay? It's very straightforward. If you're a buyer of the option, you have to be on guard for the decay of your option. If the price of the underlying does not move, the value of your option only can decay. Without taking the other factors like volatility or interest rates. If the only thing that you're looking at is price and time, if the price doesn't move, then the value will decay. That's what we want because we are selling it. We sold it to him for $10. We want to see after a couple of days it's only worth 8, and then it's worth 3, and then it's worth 2, and then we can buy it back for pennies when we sold it for dollars. How does implied volatility affect theta? Implied volatility is a different factor of options. It's the variability or the volatility at which the price of the option of the underlying moves up and down in a day. That affects delta. It does affect time decay somewhat, but basically you're starting with an option that has a bigger value. Instead of starting at $10, maybe you can sell it for 15 or 20. It still decays at the same rate, but you're starting from a bigger number. That's how implied volatility kind of fits in there. All right. Let's go ahead and keep moving. The second point, what about time decay? Now, I've alluded to it because I've told you how it decays. How weekly options, which is what we normally trade, how that decays, and how do we trade that on a calendar. All right. Again, I'm reiterating here, and I want to start right here. For weekly options, the greatest rate of loss of value is to time decay is in the last 1 to 2 days. Guess what options I want to sell? Weeklies. If I sell monthlies, well, I have to wait an entire month until it expires. Weeklies, I can do that 4.3 times every month. Okay? 52 weeks a year, I can sell something that I'm looking for to keep the profits. It's almost like going out, selling somebody something for $5, and then after a couple of days, I get to keep the $5 because it's worthless now. I do it every single week. Okay? Again, option sellers are using theta to their advantage. We're collecting profits due to time decay every single day. And specifically, we are doing credit spreads. Okay? I know a lot of you have heard this before. I appreciate the experience and the knowledge, but I think it's good to see where I'm actually coming from. Okay? So, again, if I'm selling weeklies, when do I want to do it? When do I want to do it? Justin, if the stock that, if there's a stock that you want, you don't have to sell, you don't have to own the stock to sell calls. Now that's kind of a covered call strategy. I'm going to show you a way to do it in which you don't have to own the stock. You actually will both, because we call them the spreads, we will sell the option, we will sell the call, and we will buy another call that expires the same time. That long call acts as the long stock. It's a long position, but that's we'll talk about that in a little bit. All right, so Mondays, we have 4 days left till options expiration. Don't really want to expose ourselves to 4 or maybe 4.5 trading days until expiration, which is Friday. So normally don't do it then. Now, on longer term trades, and kind of as a swing trading kind of point of view, we actually sell credit spreads on Tuesday, but we do it in a different manner. This is what we do in our trading room. So Tuesday is a good day because we have more premium we can sell because we have a longer time span until Friday. That's not the 11-hour option spread strategy. Okay? Wednesday, we're basically monitoring our positions from Tuesday. Sometimes we'll sell more credit spreads based on, if it's an FOMC announcement or something like that. So there is a possibility of selling some on Wednesday, but that's not really the main function. What you're here for is this opportunity right here. We want to do this on Thursday. This is our 11-hour credit spread strategy. We sell credit spreads in a particular manner on Thursday about midday. Okay? And then all we do is let options kind of decay from Thursday night into Friday. Okay? That's what we try to do. This is a longer term chart, but right here is what you want to do. Our time exposure of the week is from 12 o'clock noon on Thursday to 4 p.m. on Friday. That is 11 hours. Why is that important? Because that is only 1/3 of the week. Okay? The other 2/3 of the week are here. If you think about it, the longer you have money in the market, the more time exposure or risk you have in terms of time, because the market can take the money away from you. So if we can get a reasonable amount of premium in 1/3 the time, I'd much rather limit my risk exposure. So that's why I do it there. That's where we come up with 11 hours. Okay, any questions regarding that? Yep, Thursday around noon. Can be plus or minus an hour. That's not a problem. Okay, Chuck, I'll show you some examples. All right, so here is the 11-hour option strategy kind of in summary. All right, this strategy is a high probability trade. I've been running these trades in my room over 9 weeks already. I came up with the strategy because we wanted to have an opportunity to trade the overnight time decay where it is strongest, and that is Thursday going into Friday. We just needed a methodology to do that. Now, with, I'll say 80% or more. The good thing about this, I will actually show you the trades going back 9 weeks, and I'll just show you what exactly we did. Okay? The overnight trading focus that we have. Okay? That is what we want to do. We're going afternoon on Thursday into 4 p.m. close on Friday. Okay, these trades are based both on the daily and 60-minute chart. Okay? That's the important thing. We use them in combination. And the way we evaluate particular candidates, okay, is momentum, support and resistance, Fibonacci retracement, and extension levels. I see some questions out here. Let me quick touch on them. Okay, is first of all, how is probability determined? Okay, my probability, when I say high probability, I'm basing it on historical transactions. I've been doing this over 9 weeks, and I've taken a large number of trades. I think it is a reasonably good body to compare it to, because it's been very consistent. Okay, there's not much volatility in the differences. It's not like, well, we lose 60% and this week we get 100%, and then we only get 1 out of 5 this week. I'll show you those results. Okay, yeah. What's the probability to complement delta? Okay, I'll keep going because I don't want to interrupt the flow of this particular, because this describes the strategy right here. Okay. So the ultimate goal of this strategy is the overnight time decay. And then if we select the candidate really well, not only do we get a decent income, but also the delta comes into play in the morning, and then it continues, and we have a lot of our income right away, first thing Friday morning. Okay. All right. So those of you that have traded the strategy, selling credit spreads before, we want to do it from the standpoint that takes a different mentality than saying, hey, I see the stock is going up. The momentum is carrying it up. So let's get long, or let's buy stock, or vice versa. Stock's falling. Wow, this thing's accelerating down. Let's go ahead and buy puts or short the stock. Okay? Selling credit spreads, different mentality. What you want to do is, if you think it's going down, if you think the stock is going down, well, this is the area you want to sell the credit spread. Does that make sense? Here's your chart. Okay? It's falling. That's where you want to sell credit spreads, right there. Okay? Next thing, if you think the stock is going up, well, you want to sell your credit spreads down here. You want to sell away from the projected price direction. You want to know where prices will not likely be. And again, the factors that influence that is, what is momentum doing? Are there support and resistance levels between the current price and where you're selling away from? Okay? Put a fib. If you have a major move in place, you have a Fibonacci retracement or extension level, and you have a good method to seeing, and you have a higher probability that it's going to go higher, then you know that, hey, this is a safe zone. That's where I'm going to sell my credit spreads. Okay? All right. So, again, I'll answer that question, Glenn, just a second. Again, profits come primarily from theta decay. You are looking for the decay of the options from Thursday going into Friday. What we are trying to do is generate on the money that is expended in terms of buying power. We want to generate anywhere from 4 to 8%. I'm sorry, this is wrong. It's supposed to be 40. $40 to $80 per thousand. You look at that and it's like, hey, that's terrible. Well, that's about what stock indexes have been doing every year for, what, 20 years? Okay? If you got an 8% return in your index fund over the past 20 years, you're happy. Well, I'm trying to pull 4 to 8% every week. Okay? Now, I can talk a little bit more about risk control, but basically, if I'm looking to get $40 to $80 every week per thousand, I'm only going to risk 80 to 160 per trade, per thousand. Okay? And again, because of the high probability nature of the stocks, it works out mathematically that over periods of time, you're going to be consistently profitable. Again, this is not a strategy that you just do once and look for a home run. No, this is a strategy we do week in, week out. It doesn't require a lot of effort, but it requires consistent application of the strategy. All right, so this is just a quick example of someone looking at the chart, and I say daily, this might as well be a 60-minute chart. So 60-minute chart, Google comes down, finds a bottom right here at 856. We bounce higher, we come down, okay, find support at 845. This, for those of you who don't know, is a bullish divergence on momentum, and it looks like price is going higher. Let's say this is going into the close on, going into noon on Thursday. So if this is where we are right now, okay, that's the current price. Where is it likely that the price of Google will not be in the next 11 bars? Okay, well, here's one bottom. Here's the second bottom. Momentum's carrying it up. So these inherently make support levels based on their points of inflection. So below those 2 points of inflection and away from momentum, this area right here in the purple line, $840, that is a reasonable strike to sell your credit spread. 840 by maybe 835. I'm not going to get into the very specifics of the credit spread, but right here, this is where you try to get 4 to 8%. Okay, that's how much credit you're looking to capture. All right, is that pretty clear? Yeah, that's a 60-minute chart. It doesn't matter. All charts are fractal. I can show you this right here on a daily, and it's the same thing as an hourly. Okay, it's the idea of this is where we want to sell the credit spread. We're selling away from where the price and momentum are carrying us, and behind support and resistance levels. Okay, next one. Okay, let's say CMG. Right here, what's happening to CMG? It's starting to fall. Okay, it's about noon on Thursday. It breaks through after opening a little bit higher. Now it's breaking lower. Where's this price likely not to be? Well, in my eyes, I see CMG's been in a range right in this area. Okay, we can either sell the 540s right here. Okay, that's a reasonable risk. Or if you're more risk adverse, let's move it further away from the current price. 550. The price is right down here. What is the likelihood with momentum going lower? What's the likelihood this thing's going to turn on a dime, go straight up, going back through this channel, and then breaking out the top up here in the next 11 bars? Probability is pretty low. Okay, the way I trade credit spreads, I trade based on support and resistance and momentum. You can look at this and say, well, what's the standard deviation up here? Guess what? In my mind, in my experience of doing this for years, in all honesty, the stock doesn't care what this number is. They're not going to measure it and say, oop, that's 1.5 standard deviations, let's go down. Now it's like, oh, we only have a 95% chance of breaking through that. That doesn't matter. If momentum flips around, it'll go through that no matter what. If you're not paying attention what's going on in the price action, it doesn't matter. If we're down here and momentum is heading lower, that's one thing. If we're down here and momentum is starting to go higher, yeah, that's still 2 standard deviations away, but momentum is heading in the opposite direction. You better pay attention to that more so than the distance. Okay? I see a lot of questions. Give me one more example, and then I will answer that particular question. Okay, so you guys saw Google first, and this is that was CMG. This is Tesla. What do we have here? We have 1 high, 2 highs. This, to me, this is 1 momentum. This is 2nd momentum. This is a bearish divergence, and prices are heading lower. Momentum is actually red and going lower. So we have this high right here. We have this high right here. 2 points of inflection, creating resistance levels to the upside price action. So where are we going to sell the credit spread? At 190. Okay, I really don't care how many standard deviations that is. All I care is which way is the stock going, which way, what, if it goes against me and starts to go up, what does it have to get through to get me? It's almost like the offensive lineman. This is my quarterback. Okay, that's my quarterback. If the defensive line's coming through, I want to know how fast they're going. I want to know how strong my protection is in front of me. Those of you who want to use a sports analogy. Okay, to my eyes, momentum is going down. Guess the defensive guys, they're already backing up. I'm not worried about them getting my quarterback. Okay, all right, so to answer the question is, what stocks do I do on this? In my trading room, I have a handful of 25 stocks. They are large value. They have relatively high implied volatility, and I get to know their nature very, very well. Okay, I'm sure all of you know them. I'm looking at the list right now. Tesla, Google, Netflix, Priceline, Amazon, CMG, Baidu, LinkedIn. Used to be Apple before they killed it with that 7-to-1 spread. Those are the main ones because they tend to have large prices. There's a nice, most of those strike prices are anywhere from $5 apart to $2.50 apart. Okay, there's plenty of volume because there's plenty of stock volume. You have a lot of options to trade. With a lot of options, you have narrower bid-ask spreads. Okay, you can get a consistent income. If you guys know what this means right here, when I was showing you the 4 to 8%, okay, you're looking anywhere from on a $5 wide spread, you're looking anywhere from 20 to 40 cents spread each week. Okay, 20 to 40. And we find it all the time. And I will show you. Okay, so those are the stocks we trade. I use those a lot, and we can make a lot of money. Again, high implied volatility means that the premiums are a little inflated. Okay, they're kind of fat. That's what you want. You want to sell fat premiums. Okay, it's easy to read momentum because these are well traded. It's not like other than Tesla, from which we can jump 5% when the CEO sends out a tweet. That happens every once in a while, but most of the time it takes a lot to move these stocks, and they can move. But it's easy to read momentum. It's easy to get in and out. It's easy to have the liquidity and the options. That's what you want. You don't want to trade some esoteric $30 stock with five options in the open interest of open interest at a particular strike. You will pay through the nose and get almost no premium. That was the origin of that first question that came through earlier. You can't find premium. Well, you can't find premium because you're buying and selling the wrong thing. Okay? You get to know these stocks. Yes. The one question was, hey, if one of these goes against us, you know, right here, it's a $5 wide credit spread. Well, oh, I could take up to a $5,000 loss. That is correct. That's why we limit our risk to either, okay, this is 40 to 80 is our income goal. I'm willing to risk 80 to 160. Okay, I'm not doing just one of them. I might do 2, 3, 4 trades a day. So if I get one that really goes against me, I may break even that week. I don't mind taking a break even week. I don't lose money. And if you don't lose money, you can consistently make money. Okay. All right, let me just go ahead and touch on this. The 11-hour strategy, our goals, generate consistent winners. Okay, create consistent gains. Okay, control our losses. Right, so what I'm going to show you, this power of compounding chart. I'm not going to really go into it, but let's just say we start out with 10,000. And yes, everything is compounded. But I want to give you a picture as to what is possible if you can be consistent with your trading. Let's just say we do 2% a week. Right? 2%. Remember, my goal is 4 to 8. Let's be realistic. 2%. Okay, do this 52 weeks. We'll do this a month. You're going to have an increase in your account of 10,000 of 8.2%. Okay, if you do this every week for 52 weeks, you're looking at a return of roughly 28,000. You started out with 10. Now you have 28. You can do the math. I'm not here to wow you with big numbers. I'm just showing you the math. I'm not doing anything else. Okay, I technically like to use the 3% number because I think that's more realistic. So 3% a week, 10,000. That 10,000 in a year goes to 46. Let's say you're just conservative. I'm still good with 30, 35. Okay, that is the potential power of weekly compounding. Just want to show you. That's kind of what we're trying to get in our mind as something that could be possible. Okay. These are the actual trades I've taken for the past 9 weeks. Okay? This is Tesla. This is a bearish call credit spread. My short strike is at 222.5. It's a $5 wide spread. So I commit $5,000 to this trade. I'm not going to do this for everyone. Okay, 5,000. What do I earn with my 5,000 worth of buying power? I earn $440. Okay? 440. Okay, same thing here. I consistently do the same kind of trades. It's easy for my room to understand. $5 wide spread, short call here, 595. 11-hour trade, get in there on Thursday noon. We get 30 cents. Okay, this one is successful. We keep $300. Basically, I let them go to expiration. Okay, and please, yes, before anybody asks, yeah, this is just kind of the gross. Take out a little bit for commissions, maybe 10%. You'll see what we're talking about. Okay? And Dan, yes, I do use stops. Okay? Price line. Okay? This is a $5 wide spread, 10 spreads. I sell, get 25 cents. It's $250. Okay? You'll see in my results, sometimes I don't use the biggest credit. Okay? I could be a little bit more aggressive. Me, I'd prefer to be more conservative. So, right here, you add this up, made 990 over 15,000 buying power. Okay, what is that? That is 6.6%. Okay, first week I formally did it in my trading room, 6.6%. Here, the next one. Now, you can see I do have some credit spreads that I put on Tuesday and Wednesday. Everything that you want to look at is in the green. Okay, 11-hour trade, 11-hour trade, 11-hour trade. This month, I made 670 based on 1,500. That's 4.5%. Oop, I can't write. 4.5%. That's the second week we've done it. This is correct. This was profitable, profitable, profitable. Next, price line again. You guys notice this is the same stocks again and again. Actually, this is an iron condor or something very similar to it. It's actually unbalanced iron condor. So actually, I don't have to commit as much. But again, bearish call credit spread actually brought in. This is incorrect. I actually think this was just 10. This is correct. 600 here, 430 here. All these expired worthless. Made 6.9% on this one this week. Just the ones in green. Just the ones in green. The other credit spreads are also profitable. Look at this week. This one we went hog wild. First week of August. Profitable, 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 profitable. Okay, $1,600. Made 6.2%. I let them expire most of the time, Linda. Chuck, you may have to check it, as long as everybody can hear me. 6.2% there. See, I kind of have a consistent record here. Now this is, I'm not perfect. See, this trade went against me, but that's a Tuesday spread, Tuesday-Wednesday spread. That one went against me, okay? But credit, 11 hours in green, that's profitable, 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 okay? Unless I tell you they're profitable. 4.3%. Okay? Again, same thing here. 5.3%. 5.3. Tom, yes, if you don't use the risk control that I teach you, yeah, it can blow you out of the water. I don't mind getting stopped. I don't mind losing $340 here because I got gains here, here, and here. Okay? I'll take that stop. That's part of doing business. That happens. But I'm just showing you the results as they came. Okay? So get stopped out there. But I didn't. This is still good. This is that's a good trade. Give me a second here. Gotta find my pen. So that's good, good, good. So this one is 5.1%. I'm sorry, I don't mean to bore anybody. This is the first week of September. This is the third week of September. I actually went on vacation. This is 4.3%. Okay? And this is the 26th. The 3 that we took, we made $600, made 4%. Okay? So again, the goals of this strategy, consistent winners. Okay? We took 34 trades. There were 34 out of 34 winners. I didn't make it up. It's what it was. People in my room took the trades with me. Okay? Consistent gains. Okay? I want to get a consistent average weekly return. 5.2% weekly. Okay? I want to control my losses. Okay? Did I have any losses? No. But, so that's 0. But basically, it's 2 times, my stop is 2 times the profit that I'm going to potentially receive. Why do I do it there? Well, again, it can be anywhere from $80 to $160 loss per 1,000. And I do that because I know that there are going to be losses. This is never going to be perfect. But you want to be able to bounce back relatively quickly. If you guys know, you just sold iron condors. I'm sure you guys have done iron condors at earnings and stuff. It's great when you get 7 of 8, 7 in a row. What happens on that 8th one when you get blown out of the water? You get really, really, really killed. All your profits are gone. Now you're either at break even and have to start over, or you had a loss. Okay? That's why I control my risk. 2 times max profit. You can see some of my Tuesday trades, they actually took a loss. And that's fine. That's part of doing business. So again, I showed you that the weekly return we've been doing for 9 weeks, which is roughly 20% of a year, 5.2%. I told you to look at the 3% number, but right now we're on track for 5. I'd be more than happy with 3. Okay? 10,000 at 5%. Yeah, I can't promise you that. I'd love to. No, I just buy it back. I don't defend my credit spreads. Either they're right and I get that time decay, or I'll get stopped out. because the premise behind the trade is time decay, theta time decay overnight, and being relatively correct on the momentum the next day. How do I manage the risk? Same thing, 2 times max loss, max gain. Any more questions? Okay, Kim, what do I mean by 2 times max gain? Okay, I do a $1,000. I commit. Here, I'm sorry. Let's just say I put a credit spread on, and it's 2 contracts. Okay, 2 contracts. That doesn't matter. But the buying power taken up is $1,000. Okay, that's how much the broker holds. That's how much technically my max loss could be if it goes all to hell and he goes completely against me. $1,000. I'm looking to get $40 to $80. Okay, I've been getting roughly 50. Okay, that's my maximum gain for the week, or at least in the 11 hours. I can earn $40 to $80 in the next 11 hours. That's the credit I receive. Okay, what I mean by 2 times max gain is if I'm going to earn 40, the most I'm willing to lose is minus 80. Okay, I'll put my stop loss there. So that's the most I want to lose. Okay, if I have an $80 max gain, the most I'm willing to lose is 160. Okay, that's it. That's all I want to do. Now, there have been times it'll gap against me and stuff like that. There's certain things I can't control, but I tend to watch it intraday, and I usually work my way out of it. And but like I said, I haven't had a problem because I haven't had a loser yet. No, the 160, because what's happening, I sold it. I sold the golden ticket to John over here for $80. Okay? When it goes against me, it becomes more valuable. So John's saying, "Hey, buddy, I'm not going to," I say, "Ooh, I'm exposed. I don't want to be exposed because it might go against me and I might lose this big gigantic number here." And John over here says, "Hey, okay, now it's moving against you. It's more valuable to me. So I will sell it back to you, but I'll sell it back to you for $240. You're like, "Wow, that's crazy. You're going to make me pay $240? I sold you. You only gave me $80. And now I have to give you back $240? Yep. So in the transaction, if I got $80 and I have to put out $240 to buy my risk back, I basically lost this, $160. Okay? That's my loss. Yes, the risk is very small because I'd much rather lose 160 than 1,000. Okay, I can basically, if I have 2 or 3 or 4 credit spreads, I can basically make up this loss with the other 2 or 3 in the same week. If it'll take me 4 or 5 weeks to make up $1,000 loss. I don't defend it. I don't do any of that stuff. I'm a trader. If there's a loss, take the loss. Okay. All right. So now I've showed it to you. I've showed you the potential on a weekly basis. Now I want to stress that this particular workshop is designed to make a full-time weekly profit, and you're in the market only 1/3 of the time. No, I don't use deltas, John. I don't use deltas. I don't use standard deviations. I don't do all that kind of stuff. I look at support and resistance and momentum, and I make a trader's determination as to where it's supposed to be. Don't worry, I'll teach you how to do that. Okay? But again, I'll answer questions right at the end here. But I just want to let you aware that this workshop is available to you now. Okay? It will teach you how to make full-time weekly profits being in the market 1/3 of the time. It is a high probability. Remember, 34 out of 34? Again, I can't promise you it'll be like that for the next, 100 weeks, but 34 out of 34 is what I have to show you. Okay, you're making a consistent high probability income trading just 2 days a week, not 5, just 2. Now, those of you that have an established trading methodology and everything, this is kind of a set it and forget it kind of strategy. Hey, go into the market around noon on Thursday, take a look at the market, follow the step-by-step method to select the good candidates, and once you set it, you put the orders in. Once they get filled, then you put your stop loss in there. It's done. You can let it manage itself. Okay? What you get in the workshop is a detailed step-by-step method. Okay? You follow the steps 1 through 6, and it will tell you how to find the optimum strike prices. Guess what? It's not going to be in the same stock every week. Okay? It may not be there. And that's why some weeks I did 8 and some weeks I did 3. Okay? It just depends on if the opportunity is there. Okay? I will teach you the risk control method I use that allows a little bit of wiggle, but really manages the risk. Again, you're taking advantage of something already in your favor with the overnight time decay. It doesn't matter. The markets can't hold that back. Time will progress, and that puts money in your pocket. Okay? But we also need risk control in case the stock bounces around a little bit. But the method has been proven. Long-term profitability is what we're after. Now, again, this workshop basically teaches you this particular trade setup that you can do and run profitably 52 weeks a year. You're only committed that small period of time, 1/3 of the time that you're exposed. You set it, forget it, Thursday around noon, put the trades in, it's all set. You take a look at it the next day at the open, you see that time decay and see what the market's doing. And, you don't have to do really anything else. How many contracts do I do with a $10,000 account? Well, I was showing you 10 spreads. That's $5,000 a piece. So you'd be doing 20 spreads. That would be your capacity. However much money you commit to the strategy, it's up to you. You can do $5 wide spreads or $500 a piece of buying power. So however many you want to commit. And I definitely do the stock selection. Let me give you the reason why I use a particular basket of stocks, because I already know that they are good optionable stocks to trade. Okay? If you're out there always worrying about what's the stock, you're not focusing on the right thing. You might have a perfect setup in the stock, but if it has really bad options, you get really bad fills and there's really very poor implied volatility, very poor open interest. Well, yeah, there's only 25 options out there at your strike. Yeah, you're going to pay through the nose and you're not going to get much premium. Okay, remember, these are selling out of the money options. I mean, that's a little basically what you're doing. Okay, let everybody else hope and pray that it moves your way. You're a business. Yes, these are weekly options. You can do ETFs. The problem with ETFs is that you can use the smaller increments. Instead of $5 wide, you could do $1 wide. You just have to do more contracts to get the same kind of income. The problem there is the Thinkorswim doesn't ask you, oh, okay, this is much smaller, we're going to charge you less per spread. No, they don't care. They say, okay, that's 20 options, I'm going to charge you for 20. Versus, oh, this is 5 or 4. Okay, I'm only charging you for 4. It makes sense to do it the way I show you. Okay? Your commission cost gets closer to be less than 10% versus, and I did this comparison when I trade the ETFs versus individual stock one time. Same move, okay? Same move. My commissions on my ETFs was 33%. My commissions on my individual stock was about 10. It's more expensive to do ETFs. Okay. Yep. Yeah, I have no problem doing it. You get some benefit from doing ETFs, but it's not worth it if you're not going to get paid. Most people say, hey, do the, and sometimes people are overly aggressive with their credit spreads. They say, wow, this credit spread, it's a $5 wide spread. I can get $1. I can get $3. I mean, $2. Yeah, you're gonna pay risk-wise for that. Okay? Mine is common sense. Mine is based on proven trading tactics, and that's basically what you need for this strategy, because it is a little shorter term, but it's combining different important aspects of the trade together to generate the consistent income, and that's what I teach you. Okay, now guys, the last time I ran this 10 weeks ago, I mean, I have people coming back saying, this is like their favorite strategy. I'm telling you, you don't have to make this your end-all, be-all, but if you want to, you can. This could be the only strategy you trade every week, and you can make some pretty good money. All right? Now, normally this thing should be priced at $199. I'll tell you. You can make $199 and 10 times that over the course of a couple of weeks, but we initially had it priced at $97, okay? Because we want you to get to know us at Microquant, because we have really good trading tools and methodologies. We have a consistent way to make income and good trades. We want to give I use that word, give you this 11-hour option spread strategy for only $49. Guys, this is like taking your spouse out to dinner, okay? $49. I think it is an extreme value because you probably pay more in commissions trading spreads right now than $49. But it is immediately available. You just need to go to valuechartstrading.com/11, like 11 hours, 11. Let me put that in the chat box. What indicators do you need? Okay, give me 1 second. I can't type and talk. Okay, look in the chat box. There's the link. What indicators do you need? I'd love for you to get all the value charts ones and use them exactly like I do, like in the trading room. That's not necessary. I don't teach you that. You can trade this with MACD and regular open, high, low, close chart, or even candlesticks. It doesn't matter. Whatever your flavor of chart you like, I teach you the methodology. If you can read like maybe a couple of moving averages, if you can read support and resistance, excuse me, like I show you, if you can read, hey, momentum is going down or going up based on MACD, you'll be fine. You'll be fine. It's the method. It's not some sort of secret sauce embedded in a particular indicator. It's how you use your tools. This is a recording. Yes, I ran this 10, 11 weeks ago. No, I don't trade iron condors with this. The iron condors that I did show you, okay, that was because I put a credit spread on Tuesday, and then Thursday about noon, there was an opportunity to put the opposite side iron condor. I mean, opposite side credit spread. Turned it into an iron condor. When you can do that, it's money, because there's, you have a bearish call credit spread and a bullish put credit spread. Well, your broker looks at that and say, the price can only be in one place on Friday at 4. So I'm not going to make you pay buying power on both. Okay, they'll only make it so they only make only one of the legs. It holds buying power up. The other one is basically free. So you magnify your return. Yeah, the list of stocks is in the workshop, Russell. How much is the trading room? Oh, that's a good question. All right, so let me just quick get out of this. I will show you. I don't have a slide for it. And let me see, what other questions did you have? I'd be more than happy to answer them. Give me a second. Let me get value charts up, and I will show you exactly how to get this, because this is another opportunity, okay, for you. Go to valuecharts.com, okay, and you go to this blog right here that has all our daily videos. Do you see this platinum membership? $7 for the first 30 days. It's normally a $97 membership. It actually is going to increase before the end of the year here. But right now, you can try the platinum membership, 30 days, $7. If you thought that the value charts, the 11-hour option strategy was a good deal, this is even better deal. Platinum membership, $7. I trade these spreads in the trading room every Thursday. If you pay $7, come in there for 4 Thursdays a week, and then you'll be more than paying for it. That way you don't have to stretch your mind too much. It's already there. Okay, go to valuecharts.com/blog. Right there, there's the platinum membership button right there. Okay, but again, just jumping over to the strategy. Go to valuechartstrading.com/11. It's $49. You can get it now. You can watch it tonight. And I always make myself available. If you have any questions at all regarding parts of the strategy, send me an email. It is my email. Okay. It's okay, I'm going to write it here. Try to write it neatly. Dave. Gosh. Anybody ever try to write with a mouse? Dave at micro, M-I-C-R-O, quant, Q-U-A-N-T.com. I will answer you. I don't have a secretary or anything like that. Dave at microquant.com. Be more than happy to answer any questions about the strategy. We have 3 credit spreads in there right now for this week. But right now, $49. It should be 4 times that much. And that would be a good deal. But right now, $49. We want you to get to know us. We want you to be able to put some money in your pocket. Okay? We're all about making traders successful. That's our main focus. Okay? This strategy works, folks. I've been testing it now almost 2.5, 3 months. Okay? Very consistent. Again, roughly a little bit more than 5% every week. Okay? Y'all have any other questions? The platinum membership. The platinum membership, this is separate from the platinum membership right here. Okay, this is the, you don't need to be a platinum member in order to buy this. You can get this and just say, thank you very much. I was just showing you the platinum membership if you want to step in my trading room and take the trades with me. How long is the recording? I believe it's 2 hours, John. Yes, you will always have access to it. It's all yours. The platinum membership have trading tips? Nope. It's live trading. It's not an educational program or anything like that. We actually show you trades in the trading room. We give you strategies. We actually give you end-of-day strategies. We do a lot of videos. What's the maximum minimum you recommend? I know somebody trading this strategy kind of on the small side with about 3, 4, 5,000. They're fine. How many different methods do I have? Oh, Rick. Yes, this is a recorded on-demand workshop. I ran this exact workshop about 3 months ago. It's still very good. There's nothing dated around it. Strategy hasn't changed. Sounds good, John. How many different methods do I have? Well, this particular strategy, Johnny, is it's very consistent. Again, I apply this strategy to about anywhere from 20 to 25 different stocks. I look at it. I go steps 1 through 6. If it fits and I feel good about that, I'll take it. And like I've showed you, I've on the past 9 weeks, I've taken 34 trades. 34 divided by 9, that is roughly 4 trades a week. Sounds good, John. Let me know if you have any questions. Thank you for purchasing it. I appreciate it. Rick, everything is you go through valuecharts.com, you put your username and password, you get access to it right there. Yes, Chuck, it is a step-by-step process. Steps 1 through 6. Do this, do that. If it meets the criteria, it's almost like a checklist. Does it meet first criteria? Good. Identify this. Find support and resistance here. What's the premium look like? Where you put your stop loss? All those things. Keep going. Sure thing, Sandy. Ask away. Those of you that have already purchased the offer, thank you very much. Those of you that are still thinking about it, if you want to ask me a question, go right ahead. You can send me an email. I'd be happy to do it. I think you can't really let this opportunity pass up, because for that, I mean, it is a really step-by-step formula for making consistent income. Sounds good, Chuck. Let's see here, Sandy. Okay, again, how to get the $7. I think after you buy it, they give you the opportunity to also get the membership. But just in case it kind of you miss it, you go to valuecharts.com, www.valuecharts.com. Okay, you get to our main page. Oops. Hold on. System is a little bit grumpy. This is the valuecharts.com page. Okay. Click on blog. This is the quickest way I can tell you. Right here at the top of the page. Try the platinum membership for $7. Click. Right there. The 11-hour option spread strategy. How long is that offer good for? I'd get it. Why wait? It's $49. Again, we're raising that price. It's just that we wanted to give you guys, I know that you may be a little newer to value charts and our methodology of training. We appreciate you taking the time, so we wanted to give you something of value for your time spent tonight. You've seen what I've been doing. Okay, you've seen some of the results. This is the method. Take advantage of it, guys. It's $49. So I wouldn't delay. Yes, Dan, the distinct guidelines. I do also talk about the environment, the trading environment for, is the market falling through the floor? Is it going gangbusters and going straight up? Kind of how to keep that in mind when we are actually placing and selecting these 11-hour option strategies. And again, what's nice about these strategies is the fact that it comes around every week. Okay, if you're on vacation, you don't have to do the trades. You don't have to monitor the trades. But if you have the opportunity, might as well put the trades on. It's not, you go through the criteria, probably take you 30 minutes. Okay, put the orders in. If you get them filled, manage your stops, and just let it go. Sandy, you're going to have to talk to your broker about that. Because you're selling credit spreads, they automatically hold particular buying power amounts. No, sounds good, Glenn. Hey, John. Yes, this is recorded. This workshop is actually available right now. It is available right now. All you need to do is go to, let me get that up right here. Go to valuechartstrading.com/11. The offer is right there. If I get a big move on Thursday, do I close it out or do I still let it ride overnight? Well, the question is, did it hit your stop loss? I show you how to set the stop loss. I don't care if it's Thursday at 3 o'clock, Thursday at 1 o'clock, Friday morning at 10 o'clock. If it hits the stop loss, that's when you should be getting out. I don't see why the strategy would you know, you are going to get certain periods in which it's actually easier than others. If you have a lot of volatility, I can see where this might come into play. But hey, we've been really volatile in the past couple of weeks, and then we're still making money. Ray, it should be available sometime this evening. I'm going to put it up on valuecharts.com. Ron, anytime you see the indicator, it would actually help. Okay, I'm not telling you to buy the indicators. I'm telling you that it's almost like if you're a craftsman, if you're a woodworker, well, you can get by with the tools that you need. But if you want to fully explore the creative side of trading, that value charts indicators really make a big difference. When do you get? What will I get with the workshop? Well, again, it's a 2-hour workshop. It's basically a step-by-step method. Right here. I can't lay it out any easier than that. I mean, other than me putting the trades in for you. Yes, Sandy, you can take your gains anytime you want, but if the trade is really going your way because of the fact your time decay, you're selling something and Friday morning it's going your way, there's no reason to buy it back because it's rapidly decaying. I use Thinkorswim, Dan. I think I pay about $1.50 a contract. I know there's lesser rates. It's irrelevant to the platform, Ron. This is a method. You can trade with any broker, any chart system, anything like that. All you need to do is be able to read the charts, maybe some moving averages, and then what momentum is. You can use MACD or you can use our really good MQ momentum indicator. Oh, great, Dan. Oh, NinjaTrader will work. Yep. You're welcome. Again, those of you that have taken advantage of this opportunity, pat you on the back. Guys, really, $49. You can make that with one trade, guys. One. You'll probably pay more in commissions. Actually, you know, probably 2 trades you'll pay commission. That's the same amount. I'm not saying that's what you're going to make. I expect you to make more. Okay? No promo code. Just go to valuechartstrading.com/11. It'll look exactly like this. You put the information in, pay it, and then you'll get the instructions as to how to access your video. Watch it tonight. Let me know if you have any questions. No, I don't do calendar spreads, Dan. You're welcome, Kim. When is the next live trading on this strategy? I don't know. I'm working on some new stuff. This I like to show people because it's done very, very well. It's very simple. It's something that anybody can do in addition to if they trade other things. If you're an intraday trader and that's all you do, then that's fine. If you're a swing trader, have longer term positions, you can bolt this on, do this too. It doesn't take much time. It doesn't take much babysitting. It's kind of set it and forget it if you set it up properly. Okay? Again, I mean, it's very consistent. Yeah, this on-demand strategy is actually in a way better because you get it. You don't have to wait for me a couple of weeks down the road to do the live session. This actually is just as good. I answer a ton of questions on it, and if you have any more questions, you could always email me. So basically, you will get exactly what you need to do the trades next Thursday. Yes. A strategy can work fine with the indicators. You just have to understand what I'm telling you to do and apply it to what the tools that you have. It's almost like I don't care what kind of bandsaw brand that you have. I just care that you can cut a straight line. All right, any more questions? All right, guys, well, thank you very, very much for your attention. I know I held you a little bit longer, but I wanted to make sure I answered the questions that everybody had. Again, if you have any questions, send me an email, valuechartstrading.com/11. Trust me, you invest this money, $49 on a trade. I mean, a type of account should be 4 times as much. I think you're going to be very, very, very pleased. You stick with the strategy, apply it consistently, and manage your risk. Do those things. You should be successful. And again, we've been doing it for a long time. Okay? Yeah, it's not pie in the sky. This is real money, real people. So, okay? All right, guys. Thank you very much for your time and attention. I will leave this up. So if anybody needs to get that address, valuechartstrading.com/11. You can watch it as much as you want. Some people really do that, and that's fine. Yeah, it kind of solidifies it in your mind. Especially if you apply it, you want to double check, am I doing it right? You know, stuff like that. Over time, multiple exposures, applying the strategy, you'll become very, very good at it. The Platinum membership trial, $7. Go to valuecharts.com and go to the blog section. You'll see the tab right at the top. Click on $7. It should be immediately available, Dan. Once you purchase it, you should be able to get access to it. Sounds good, Chuck. Let me know if I can help you with anything. All right, guys. Have a great evening. Have a safe weekend. And I look forward to seeing you in the workshop from the recording. And if you join the membership, even more excited. I will see you tomorrow morning. We'll be ready to make some money. After the first month, Julie, it goes to $97. That's actually a really good deal now because relatively shortly we're going to be increasing that because that Platinum membership is extremely valuable. You get a ton of stuff. Go to the valuecharts.com website. Take a look at the memberships area. You'll see exactly what I mean. Okay, guys. See you later. Thank you. Hey, Julie, to answer your question, every trading day, and that Platinum membership actually includes both of our trading rooms, both stocks and options and futures. All right, guys, I will see you later. Thank you.